Hey guys, welcome back. In this video, I'm sharing a powerful strategy that blends Fibonacci retracement with a unique technique I call the TLL method. This combination gives you the accuracy and confidence to capture high-probability trades right alongside major market players. Ever wondered how professional traders set up Fibonacci on TradingView to pinpoint those ideal entries? Today, I'll guide you through it. We'll configure Fibonacci retracements the correct way, break down the psychology behind three forms of market structure, and explore how to apply Fibonacci for high-probability setups. And just when you think it can't get any better, I'll introduce the TLL method, designed to help you identify smart money activity in real time. By the end of this video, you'll know how to align with the market's strongest moves and trade with confidence. If you're ready to take your trading to the next level, make sure to like this video and subscribe to the channel for more high-quality content like this, completely free. See you right after the intro and disclaimer. First, let's review the three primary market types. Knowing which one you're in will guide you on when to apply the Fibonacci retracement tool. In an uptrend, price generally moves higher under strong buying pressure. There are two core phases: an impulsive move, where buyers drive the market upward, and a retracement, which is a brief pullback as buyers take partial profits. This retracement creates a window to enter before the market begins its next impulsive leg. Think of it as a short pause before buyers regain momentum. In a downtrend, selling pressure takes the lead, pushing prices lower. Again, we see an impulsive move where sellers dominate, followed by a retracement, a modest bounce as they pause to secure profits. This pullback often provides an entry opportunity for the next downward wave. A range-bound market occurs when neither buyers nor sellers have clear control, causing price to move sideways. In this environment, Fibonacci retracement levels tend to be less dependable due to the absence of a defined trend. For now, we'll focus on trending markets, where Fibonacci retracements work best. With that foundation in place, let's dive into how to use Fibonacci retracement levels to pinpoint entries in trending conditions. The 50% and 61.8% levels are crucial, as they often mark the end of a retracement and signal a potential trend continuation. Take a look at this chart example. Here, the market is in an uptrend, indicated by a strong impulsive move upward followed by a pullback. Begin by plotting the Fibonacci retracement from the start of the impulsive leg to its highest point. As the price retraces, pay close attention to the area between the 50% and 61.8% Fibonacci levels, commonly referred to as the golden zone. This zone often signals the conclusion of the retracement and the beginning of a fresh upward move. For a more aggressive entry, you could set a limit order inside this golden zone without waiting for additional confirmation. Keep in mind, however, that while this method carries greater risk, it can also deliver significant potential rewards. Take a look at this chart example. Here, the market is clearly in a downtrend, highlighted by a strong impulsive move downward followed by a retracement. To set up your Fibonacci retracement, draw it from the start of the impulsive leg down to its lowest point. As the price pulls back, focus on the range between the 50% and 61.8% Fibonacci levels, commonly known as the golden zone. This area often indicates the end of the retracement and the possible start of another downward move. For a more aggressive strategy, you could place a limit order within this golden zone without waiting for extra confirmation. Just keep in mind that while this method can provide greater potential rewards, it also carries higher risk. Entering trades within the 50% and 61.8% Fibonacci range can be effective, but I don't recommend relying on it as your sole approach. Let me give you an example to explain why. In this uptrend, we see a strong impulsive move upward followed by a retracement. We plot the Fibonacci retracement from the start of the move to its peak and set an entry within the zone between the 50% and 61.8% levels, the well-known golden zone. However, instead of holding, the market breaks through this zone, moves downward, and triggers our stop loss, resulting in a loss. So, how can we increase the likelihood that the 50% or 61.8% levels will hold? This is where I want to introduce a powerful technique I use called the TLL method. It's straightforward yet highly effective when applied correctly. With this approach, you'll add extra layers of confirmation to boost the probability of successful entries. Let's break down how the TLL method works and why it can enhance your trade setups in trending markets. TLL stands for Trend, Level, and Liquidity Sweep. For a Fibonacci retracement level to hold, all three of these factors must be present. Let me guide you through a chart example to illustrate. As you can see, the market is moving upward with impulsive legs followed by retracements. Now, here's another impulsive move followed by a pullback. We begin by plotting our Fibonacci retracement from the start to the end of that impulsive leg. Looking to the left, you'll notice the 50% Fibonacci level lines up with a prior resistance area that has now flipped into support. In traditional technical analysis, we know that when price retraces to a support level, it often rebounds. With our Fibonacci retracement approach, we also recognize that when price reaches the 50% or 61.8% levels, there's a strong chance of a bounce. Here, we have three factors aligning. First, the trend. Buyers are in control, so we're trading in the same direction as market makers. Second, a key level, a previous resistance that's now support, aligning with our Fibonacci level. All that's left is the third factor, a liquidity sweep signal, to validate our entry. In this case, we spot a distinct pin bar that briefly dips below the support level before closing above it, creating a liquidity sweep. This action suggests the market is likely to push higher with a fresh impulsive move. With all three elements in place, we can enter this trade with greater confidence, supported by multiple confluences indicating an upward continuation. We enter at the pin bar's close, set a stop loss just beneath it, and target the next resistance level. Watch what happens next. The market moves directly toward our target. When applied correctly, this type of TLL method entry has a win rate exceeding 75%, making it a highly effective way to capture profitable moves. Before moving on to the next chart example, we need to cover something essential: top-down analysis. Without it, this strategy loses much of its edge. Top-down analysis ensures we trade in alignment with the broader market trend, which is especially important when working on lower time frames. Here's how it works. If you're trading on higher time frames like the daily or 4-hour charts, you're already well positioned, as these time frames provide reliable signals on their own. But if you're trading on lower time frames, top-down analysis becomes critical. Let's break this down by time frame. If you're trading on the 1-hour chart, check the daily chart as your higher time frame to ensure the trend matches. For the 30-minute chart, the higher time frame to confirm is the 4-hour. For the 15-minute chart, look to the 1-hour chart for trend alignment. And if you're trading on the 5-minute chart, use the 30-minute as your higher time frame. The aim is to verify that the higher time frame is moving in the same direction as your planned setup. For instance, if you're preparing for a bullish trade on the 1-hour chart, you want the daily trend to also be bullish. Trading against the higher time frame trend increases risk, but when both align, your setup becomes stronger and more dependable. Now, let's move to a downtrend example where we'll apply the TLL method in a slightly different scenario. As you can see, the market is in a solid downtrend, marked by a series of impulsive moves lower followed by smaller retracements. At one point, the market breaks above a resistance level, which then turns into support as price starts moving upward. When the market makes this extended retracement, it often reverses around the halfway point of the downtrend. This is where our setup begins. First, we plot the Fibonacci retracement from the start of the downward move to its lowest point. Notice how the 50% retracement aligns with a former support that has now turned into resistance. This alignment provides a high probability zone for a potential reversal and continuation of the downtrend. With the trend confirmed and a strong level identified, we look for a signal that sellers are ready to push the market lower. Here, we see a candle with a long wick that briefly breaks above our resistance before closing back below it. This action shows the price tested the level, swept out weaker buyers, and then closed lower. This pin bar serves as our liquidity sweep, confirming that sellers have regained control. Remember, a liquidity sweep can appear as a pin bar, an engulfing candle, a long-tailed candle, or even a doji. With all three elements, trend, level, and liquidity sweep signal, present, this setup has strong confluence. We enter at the close of the pin bar, place a stop loss just above its high, and target the next support level below. Watch what happens next. The market respects our entry and moves downward toward the target. Using the TLL method with trend alignment, a key level, and a liquidity sweep can make entries like this far more reliable, especially in clearly trending markets. When executed correctly, this strategy helps capture strong moves with a high probability of success. Alright, that concludes this strategy. Thanks for watching. If you found this video valuable, be sure to subscribe and enable notifications so you won't miss upcoming strategies and tips. Drop a like if you enjoyed the content, and don't hesitate to leave any questions down in the comments. Thanks for tuning in, and I'll catch you in the next video.